Have you ever opened your annual tax document and thought, wait a minute, I didn't sell anything this year, so why do I owe capital gains taxes? If so, you're not alone. Welcome back to Glad You Asked. I'm Mike McCulloch, a certified financial planner. Today, we're talking about mutual fund capital gain distributions, what they are, how they happen, and why this matters if you hold mutual funds or ETFs in a taxable account. That's a regular brokerage account, not an IRA or 401k. Let's start with what a mutual fund actually is. A mutual fund is a portfolio of investments that can include stocks, bonds, cash, or other securities. You can think of it as a basket of investments that many investors share together. When you buy a mutual fund, you don't see each stock or bond listed individually on your statement. You'll just see the fund name, something like Vanguard 500 Index Fund or American Funds Growth Fund of America. Inside that fund, though, are often dozens or even hundreds of individual holdings. The fund company, whether it's Vanguard, Fidelity, or American Funds, handles the day-to-day oversight of that basket. Their job is to keep the fund's portfolio aligned with its stated goal, whether that's tracking an index or following a certain strategy. Now, let's connect this to capital gains. Just like you would if you owned individual stocks yourself, when a fund sells something for more than it paid, that sale creates a capital gain. If you owned those same stocks directly, you'd see the gain when you sold them. In a mutual fund, the fund manager or fund company handles those sales for everyone inside the fund. And by law, when the fund locks in those profits by selling, those gains have to be distributed to shareholders, meaning you. That's what a mutual fund capital gain distribution is. You didn't sell your shares, but you still get a slice of the gains that were realized inside the fund. And if your fund is held in a taxable account, that distribution can show up as taxable income on a form called a 1099 DIV that you'll receive in January or February. Here's an example. Let's say you invest $100,000 in a mutual fund that owns 100 different companies. Over the year, the fund sells some of those stocks for a total gain of $1 million. Each investor in the fund receives a portion of that gain based on the percentage of the fund they own. So, if your shares represent about 1% of the fund, you'd receive 1% of the capital gain distribution. In this example, that's $10,000. Now, this isn't $10,000 deposited into your account that you can spend. It's $10,000 in taxable gains that you'll owe taxes on. Some investors think a big capital gain distribution is good news, but it's really just a tax bill you did not expect. Remember, it's not always what you earn, it's what you keep. If that fund sits in a taxable account, that $10,000 will be reported to you and to the IRS, even though you didn't make a trade yourself. But if it's inside an IRA or a 401k, you won't owe taxes yet because those accounts are tax deferred, which means the taxes are postponed until you withdraw the money in retirement. Let's review this investor's situation. He owns a mutual fund worth $500,000. His cost basis, the amount he originally invested, is $100,000. So, if he sold his entire position today, he'd have a $400,000 capital gain. Now, I work with a lot of investors who are in a similar spot. They've owned some of their mutual funds for 25 or 30 years, and those positions have grown tremendously over time. That's great news from a growth standpoint, but it can make decisions more complicated because those large unrealized gains create potential tax consequences if they make changes. In those situations, we'll often look at ways to manage those positions gradually, whether that's through charitable giving, partial sales, or offsetting gains and losses in the same tax year. And here's where the surprise can happen. Even though these investors aren't selling, some years they still receive large mutual fund capital gain distributions from when the fund manager sells appreciated holdings inside the fund. When that happens, we review their overall picture and talk through what makes the most sense, whether it's staying put, trimming back, or making changes carefully in a tax-smart way. Now, back to our example. Let's say this same fund announces a 5% capital gain distribution. 5% of $500,000 is $25,000. That means even if he doesn't sell a single share, he'll still owe taxes this year on $25,000 in capital gains, because that's his portion of the fund's internal sales. At a 15% long-term capital gains tax rate, that's a $3,750 tax bill just for holding the fund. This surprises a lot of investors. They think, I didn't sell anything. How can I owe capital gains tax? But those distributions are taxable because the fund itself realized gains and passed them along to every shareholder. Now, what about ETFs? ETFs, or exchange-traded funds, are very similar to mutual funds. They're also a basket of stocks or bonds or other securities, and they often track the same indexes, like the S&P 500, which is a collection of 500 large US companies. ETFs haven't been around as long as mutual funds. They were first introduced in the 1990s, but they really started to grow in popularity after 2019, when the SEC made it easier for fund companies to create and manage them. That opened the door for more choices, lower costs, and even more tax-efficient options for investors. The main difference is how they trade. ETFs are bought and sold on the stock exchange throughout the day, just like individual stocks. And the way new ETF shares are created and redeemed usually allows them to swap securities in and out of the fund without triggering capital gains most of the time. That structure makes ETFs generally more tax efficient than mutual funds. But it's not absolute. Some ETFs, especially smaller or more specialized ones, still distribute capital gains occasionally. Let's clear up one last concept: unrealized gains. An unrealized gain is when your investment has gone up in value, but you haven't sold it. Because nothing has been sold yet, no tax is owed. Once a sale occurs or the fund passes along those internal gains, they become realized, and that's when taxes apply. So here's the bottom line. Mutual funds and ETFs are often both great tools for diversification. But mutual funds can sometimes surprise you with capital gain distributions, even if you didn't sell a thing. ETFs are often more tax efficient, but they're not completely immune. This all matters most in taxable accounts. Inside IRAs or Roth IRAs, these distributions generally impact you later, or not at all. And this is especially important if you're living on investment income in retirement. A surprise capital gain distribution could bump you into a higher tax bracket or affect your Medicare premiums. So knowing which accounts hold which investments really matters. So remember, It's not always what you earn, it's what you keep. Knowing how and where your investments are held can help you reduce surprise taxes and keep more of your returns. I'm Mike McCulloch, CFP. Thanks for watching. Glad you asked. If you found this helpful, subscribe so you don't miss future videos that make investing and retirement planning clear and simple. See you next time.